Hello and good day to everyone. For this video, we will discuss about partnership lump sum liquidation. Liquidation of a partnership means winding up the business, usually by selling the assets, paying the liabilities, and distributing the remaining cash to the partners. A business which is in the process of converting its assets into cash and making settlement with creditors is said to be in liquidation. A term which is always used by a business that is in the process of liquidation is realization, which means the sale of assets. Now, previously we've discussed about dissolution. Now, dissolution was defined as the change in the relation of the partners or the change of the relationship of the partners. Now, as I've said, dissolution does not always result to liquidation. But when the partners decide to liquidate, they must dissolve the partnership. Now, to liquidate the partnership means to wind up the business. So they will be already terminating the business. They will already be ending the business. So that would be the end of the life of the business. Now, liquidation is actually the process in which the partners will now be selling their assets. They will now be settling their liabilities, and whenever there is cash um that is left for the partners, then it will be distributed to the partners. Now, the term used in the sale of the assets is what we call realization. Now, in this lesson, emphasis will be placed on the accounting problems and procedures involved in the winding up of the partnership affairs, from the dissolution to the effective termination of partnership operations. When the business is to be liquidated, the account must be adjusted and closed, and the resulting income or loss in the final period is transferred to the capital accounts of the partners. In the process of partnership liquidation, it often becomes necessary to examine each partner's personal assets and liabilities in conjunction with his capital account. A partner may have a deficiency in his personal assets, in his partnership capital account, or in both. This lesson presents the concept that accountants must know if they offer professional services to partnerships undergoing liquidation. Now, for the learning outcomes, at the end of the lesson, you will be able to first make journal entries for adjustments and closing of books. Second, account for deficiency in capital accounts. And third, make a liquidation statement. Accounting problems in partnership liquidation. The basic objectives of a partnership during the liquidation process are to convert the partnership assets to cash, called realization of assets, to pay off partnership obligations, and to distribute cash and any unrealized assets to the individual partners. The purpose of accounting during this period is to have an equitable distribution of partnership cash to creditors and partners. Hence, it is no longer income determination that is the focus of accounting, but rather the computation of gains or losses and realization of assets which are to be subsequently allocated among the partners, the payment of liabilities in accordance with law, and the final distribution of cash to the partners. So the problem that we will be encountering here in partnership liquidation is how much would be the cash that is to be distributed to the partners. Now, of course, plus we still have the properties or the non-cash assets of the partnerships. What of the partnership rather? Now, what are we going to do with them? Of course, we have to sell them. Okay, since the business will now be liquidated and such assets will not be used anymore. Now, any proceeds on the sale will be um will will be part of the cash of the partnership, while any gain or loss from the realization of such assets will now be credited or charged to the capital accounts of the partner. Since as of this moment, there will be no profit or loss. Okay? Any gains or losses will be charged or credited directly to the capital accounts of the partners. Now, of course, we also have to settle all our obligations. That is the payment of liabilities in accordance with law. Now, according to the law, there is in order of priority as to whom we will pay the liabilities first, especially if the company has gone insolvent. Okay? And the final distribution of cash to the partner. So this is the very last thing to do. Of course, we only distribute cash to the partners as long as all the obligations are settled. Okay? And whether it may be obligations to the partners or obligations to the outside creditors, it must be paid first before we distribute the final cash to the partners. Now, there are certain rules that should be followed in the liquidation of the partnership, namely, first, always allocate and close gains or losses to the partner's capital accounts prior to distributing any cash to the partners. So that is why we will make a statement of liquidation in order for us to know how much will be left to the partners, because any gains or losses that we will incur, or we will any gain that we will earn, or any losses that we will incur during the liquidation process, will be credited or charged to the partner's capital accounts. Now, when the business is liquidated, the partner is entitled to an amount depending upon his capital contribution, his drawing, his share in the net income or loss from operations before liquidation, gains and losses on realization, and the balance of his loan account, if any. Okay? So, we will be computing um, the amount of the capital that is left to the partner, okay, after considering all these factors. Now, each partner will receive in the final settlement the amount of his equity in the business. The amount of a partner's equity is increased by the positive factors such as investment of capital and share in the profits. Now, it is decreased by the negative factors such as withdrawals and share in the losses. So, whenever there is additional investment or share in the profits or gain from realization, it will be added to the partner's equity. However, if there are negative factors such as withdrawal of the partner or shares in the losses, then it will be charged to the capital accounts. Okay, now if the negative factors are greater than the positive factors, the partners will have a deficiency and he must pay the partnership the amount of such deficiency. So class, let's say for example, that the capital account or the capital balance left for partner A is only 1,000, but the share of his loss is 2,000 pesos. In that case, partner A will now be deficit. Now, what is he going to do is he must add additional investment to the partnership and credit it to his capital account. So from a deficit of 1,000, his account will now be 0. Okay? So what are we going to do here is to eliminate all the deficiencies of the partners. And he must pay the partnership the amount of such deficiency. Failure to do so would mean that his fellow partners would bear more than their contractual share in losses, and they will consequently receive less than their equities in the business. So class, if such partner is not able to invest additional cash for his deficiency, then the persons who will absorb such deficiency will be the other partners. Okay? That is the rule. Now, as a general rule, the cash should be distributed as follows. First, whenever there is available cash already, we must pay our outside creditors. That includes our accounts payable, notes payable, bonds payable, and any other liabilities of the business. Second, two partners for loan accounts. Now, there are partners who loan to the entity. So, the entity may have an amount payable to the partners in the form of loan. So after paying the outside creditors, then we must pay the partners for their loan accounts. And lastly is for the partners capital accounts. Take note, the capital accounts must be the last one to be distributed, because whenever there are still gains or loss that will be encountered upon liquidation, then it will be charged to the capital accounts. Okay, so capital accounts should be the last thing to be distributed. Now, the rule in indicating priority of partners' loan over partners' capital is supported by an established legal doctrine called the right of offset. When a partner's capital account shows a debit balance or even a potential debit balance depending on possible losses, and said partner has a loan account, the law permits the exercise of the right of offset by part or all of his loan against the capital deficiency. As a result of the exercise of the right of offset, payment to some partners can be made in their capital balances Even there are loans payable to the other partners. A debit balance in the partner's capital account may be caused by losses incurred in the realization of assets or by pro rata absorption of an uncollectible deficit of a partner whose combined capital and loan accounts is not enough to absorb the partner's share of total losses. So plus we have what we call the right of offset. This is where a partner has a loan account and has a capital account. Now, in case the partner becomes deficit as to his capital account, then the partner has the right to offset his loan account to eliminate the deficiency of his capital account. So say for example, if the partner still has a loan receivable from the partnerships, or in other words, that is a loan payable from the partnership to the partners, let's say for an amount of 5,000 pesos. But the partner's capital account shows a deficit of 2,000 pesos negative. So by using or by exercising the right of offset, the loan account of 5,000 can be decreased by the amount of 2,000 pesos in order to absorb the capital deficit of the partner. So from negative 2,000 of the capital account of the partner, it will now become zero after the loan was transferred to the capital account. While for the loan account, there remains to be 3,000 pesos. Okay, so that is the right of offset. Now, methods in partnership liquidation. Now, when a partnership is to be liquidated by the sale of assets, the following methods may be used. First, lump sum liquidation, otherwise called total liquidation or single distribution. And second is installment liquidation, otherwise called installment distribution. Now, in the lump sum liquidation, it is the one that will be discussed in this lesson. It is, in other words, the total liquidation or single distribution. So this means that the sale of assets is only done once. Okay, so it will be lump sum. All the assets will be sold in one instance. While in an installment liquidation, okay, the assets will be sold, let's say, by batch. For this month, some of the assets will be sold, and for the next month, the other assets will be sold. Okay, so there will be a difference as to the lump sum liquidation and installment liquidation, as to the process, of course, and as to its accounting procedures. Because in lump sum liquidation, after we sold all the assets, then we can already pay the liabilities and thereby paying the final cash distribution for the capital accounts of the partners. While in the case of installment liquidation, we are only to pay the cash to the partners which is available for distribution, okay, and after settling all the liabilities of the partnership. Okay. Now we have here the realization of assets. So this is when we are to sell the assets. So any gains or loss from the realization will be credited or charged to the partner's capital accounts. For the expenses, okay, so liquidation expenses are usually incurred. So it must also be paid first before we pay any liabilities to the outside creditor. So what is the procedure? First, realize the assets and distribute gain or loss among the partners based on the P&L ratio. So first, we must sell our assets. Now, any proceeds will be given to the partnership, while any gain or loss will be charged to the capital accounts based on their P&L ratio. Next, payment of expenses. So again, there could be liquidation expenses that will be incurred during the liquidation process. Now, of course, we cannot sell the assets without paying such expenses. So it will also be deducted. It will also be charged to the capital accounts of the partners. Now, after we settle all the expenses, then we will pay the liabilities. So, of course, first would be the outside creditors, and then the next one would be the loans to employees. And the fourth one, elimination of partners' capital deficiencies. If after the distribution of loss and realization, a partner incurs a capital deficiency, partner's share of realization loss exceeds his capital credit, this deficiency must be eliminated by using one of the following methods in order of priority. So this is what I have talked about earlier, that whenever the capital of such partner is deficit, so that would be negative. So what are we going to do is first, if he has a loan balance, then exercise the right of offset. But if there is no loan balance, but he is insolvent, then make him invest cash. Okay, additional investment. Now, if ever such partner is insolvent, so he has no capacity to invest cash anymore, then the other partners must absorb the deficiency. Okay, and then the last one is to pay the partners first for their loan accounts and second for their capital accounts. Now let us answer the illustration. We have DEF partnership, statement of financial position on April 27, 2019. We have here the assets, which includes the cash and other assets, and then the liabilities and capital, which includes liabilities, loan, and capital. The partner's loan account is not close to partner's capital account, but partner capital balances before realization should be after closing the following account, if any: partners drawing, receivable from partners, and payable to partners. Case number one. Okay, for case number one, we assume that other assets of 80,000 pesos uh, were realized at 60,000 pesos. Okay, so class, this is a case where the loss on realization is fully absorbed by partners' capital balance. Okay? Now, case number one, assume that other assets of 80 were realized at 60,000 pesos. So, what we're going to do is to make a statement of liquidation. Okay, so first, let us look at the information and then plot it in our statement of liquidation. Now, for our statement of liquidation, we have the assets. Okay, that includes the cash and other assets. Then we have the liabilities. So the liabilities includes the liabilities in general and the loan of D. And then we have the partners capital accounts. We have the capital account of D. So accordingly, he will share 40%. Okay, to confirm, let us first see it here. Okay, so I haven't I haven't given the information for the P&L ratio. So for D capital, that should be 40%. For E capital, that should be 40%. And for F capital, that should be 20%. Okay, now let's go back to our solution. So we have D 40%, E 40%, and F 20%. Okay, this would be the partner's capital. Okay, so after the label, then we will put the balances before liquidation. Now for the balances before liquidation, okay, first we have the cash amounting to 20,000, other assets of 80,000, liabilities of 28,000, loan of 2,000, and capital of D, that is 9,000, capital of E 21,000, and capital of F 40,000. Okay, these are the balances before liquidation. Okay, now next, the first step is the realization of assets and distribution of loss. Okay, now accordingly, the other assets were realized at 60,000 pesos. So this means that we received 60,000 pesos for the proceeds of the asset. Okay, but the asset that was sold amounts to or has a book value of 80,000 pesos. So in this case, there is a loss of 20,000 pesos. Now, who will absorb the loss? Of course, that would be the capital balances of the partners. Since we have a loss of 20,000 pesos, then how are we going to allocate? That would be based on their P&L ratio. So we have 20,000 multiplied by 40% for partner D. That is the same for partner E, while for partner F, that is 20,000 multiplied by 20%. So this is now their share in the loss, of course, that should be negative. Okay, now next, let's compute for the balances. Alright, now for the balances, we just have to add the balances before liquidation and after the realization of the assets. Okay, so these are the balances of each account. Alright? Now, next is the payment of liabilities. Now, we have here a liability amounting to 28,000 pesos. So, since we are to pay the liability now, then we must deduct the 20,000 pesos. Okay, what will we use? What will we use to pay the liability? That would be cash. So, we will also deduct 28,000 pesos. So, in this case, we will now have another balance. That is 80 minus 28. And then so on. Okay. Now, class, take note that in a statement of liquidation, okay, I haven't put any label here, but this is the statement of liquidation. So, class, take note that in a statement of liquidation, since this is assets, liabilities, and capital, okay, um, the debit and credit side must be equal. Okay, it must be equal. So as you can see, we have here, okay, if I'm going to add all the credit side, okay, so this is the credit side, That is the credit side. So that is 100,000. Now for the for the debit side, this is the debit side. So that is also 100,000. Okay, for the realization, okay, for the realization, we have here, okay, this should be negative. We have here negative 80,000 for the other assets because it is already realized. So we have for the debit 20,000 and credit 20,000. Okay, now for the balance, it should also be balanced, both the debit and credit side. For the payment of liabilities, it is also balanced, and for the balances, it is balanced. Okay, so take note, this is not necessary, but this is just for you to check whether your statement of liquidation is balanced. So if it is balanced, then it is possible that you do not miss any, or you don't have any mistakes as to the amounts. Okay, you did not omit any amounts, or you did not omit any sign, okay, whether it would be positive or negative. Okay, so make sure to make it balance. Then after payment of liabilities, we now have the balance. So as you can see, class, we don't have any other obligation, then it is now time to pay the capital, the loan and capital balances of the partner. So of course, we will pay first the loan. So since the cash is still enough, then let us see if the partner's capital would also be enough. So this is 2,000 for partner D, 1,000 for his capital, 13,000 for partner E, and 36,000 for partner F. So for the cash, we will deduct 52,000. Now let us see if all the payments, or the sum of the payments, is 52,000. We have 2 plus 1 plus 13 plus 36, that is 52,000 pesos, and of course for the cash, that is 52,000 pesos. Okay, and this is what we call as payment to partners. Okay, that is payment to partners, and then for the last time, there will already be no balances anymore. Okay, there is no balances at the end because everything is zero, and we are done with our liquidation. Okay, the final balance must be zero. Now class, for the journal entry, okay, let us make journal entry. Let us start first with the realization of assets and distribution of loss. Now, for the realization, we received cash, right? We received cash amounting to 60,000. In that is the proceeds of the other assets that we sold. So debit to cash and credit to other assets of 80,000 pesos. Now, since there is a loss, so we will charge the loss to their capital account. So debit D capital, debit E capital, and debit F capital. So for D, his share is 8,000. For E, another 8,000. And for F, that is 4,000 pesos. Okay, this is for the realization. Now for the payment of liabilities, of course, that would be a debit to liabilities and credit to cash. Okay, that is 28,000 pesos. And next, for the payment to partners, so of course, that would now be D loan, D, E, and F capital, and then credit to cash. Okay, for the D loan, that is 2,000, 1,000 for capital, 13,000 for E, and 36,000 for F. For the cash, that totals 52,000 pesos. Okay, so this is our statement of liquidation under case number 1. Now let's proceed to case number 2. Okay, in case number 2, okay, assume that other assets were realized at 55,000 pesos. Okay, so what if the assets were realized at 55,000 pesos? What would be our statement of liquidation? Okay, so class, this is an example where there is a loss on realization resulting capital deficiency to a partner with a loan account. So class, as you can see in the first example, after the assets were realized, all the partners has fully absorbed such loss. Okay? There's no partner that has become deficit. Well, in case number 2, one partner will become deficit, but the good thing is that such partner has his loan account. So how are we going to make the statement of liquidation? Now, for the statement of liquidation, okay, first we have the DEF partnership statement of liquidation on April 27, 2019. Okay, so of course, I'm just gonna copy it here. Okay, so I copied everything, but I'm just going to delete the amounts. Okay, so the balances before liquidation is same as illustration 1, but as to the realization of assets and distribution of loss, the assets were sold for 55,000 pesos. Okay, while the book value of the asset is 80,000 pesos. So as you can see, there is a loss of 30,000 pesos. So the partners will absorb this loss. Now for the loss, we have 30,000 pesos multiplied by 40% for D, 40% for E, and for F, 30,000 pesos multiplied by 20%. Okay, so how much is the balance? So we have for the cash, we have 75. For the other assets, no more other assets. And then for the rest, we have the capital of D. That is now negative 3,000. Capital of F, 9,000. And capital of E, 9,000. And F, 34,000. So what are we going to do with this deficiency? So of course, we can exercise the right of offset. Okay, but before that, let us first pay the liabilities to the outside creditors. Now, as you can see, we have liability of 28,000 pesos, so it will be deducted from our cash. Okay, now for the balance, we have, for the cash, we have 47,000 left. Okay, no more liabilities, while for the loan 2,000, for D, that is still 3,000, E, 9,000, and F, 34,000. Now, class, as you can see, we're going to add the balances just like the loan of D case. For the capital of D, there is no more to be given because this is already negative. Well, for the capital of F, we have 9,000. For E, we have 9,000, and for F, we have 34. So, plus, if we're going to add all our payable to the partners, that is 2,000 for D, 9,000 for E, and 34,000 for F, that would be 45,000. And take note, it is not enough. Okay, it is not enough. Our cash is not enough. So, okay, let me just check. So plus, I guess there is wrong. That is why. Okay, 55 minus 80. This should be 35,000 loss. Okay, 35,000 loss, 35,000 loss. So I forgot to check the balances. Okay, I forgot to check the balances and it says that it was not equal. So we have 80 minus 55, that is 25. 25,000 times 40%. Okay, 25,000 times 40% and 25,000 times 20%. So as you can see, it is already balanced. Okay, everything is balanced. Now let's proceed again to the payment to the partners. As you can see, if we're going to add everything, we have 2,000 plus 11,000 plus 35. This is 48,000. And as you can see, the cash is not enough to pay the total of the partner's capital. So what are we going to do is to absorb this 1,000. Okay, why was the cash not enough? Because we have a negative balance of the capital. So what we're going to do is for D to exercise his right of offset. Okay, so for D, he has a capital deficiency of 1,000. Now, to eliminate the deficiency, we must transfer his loan account to his capital account. So, deduct the loan account by 1,000 and add it to his capital account. Okay, so if we're going to add, okay, if we're going to compute for the balances, we have cash of 47. For the loan of D, that is 1,000, no more capital deficiency, and for E, that is 11, and F, that is still 35. Okay, so if we are going to add the total of the debit and credit, that is 47,000. So 47,000 for the 35, 11, and 1, and 47,000 for the cash. And so therefore, at this time, our cash is enough to pay the partners, so we will now pay the partners. Okay, for the payment to partners, we have for D, 1,000 for his loan. For the capital, there's no more. For E, that is 11,000. And for F, that is 35,000. Okay, so that is our statement of liquidation for illustration 2. Okay, so class, for our journal entries, okay, the realization is just the same with our journal entry in case number 1 as well as the payment of liabilities. Now what I'm going to present is the journal entry for the absorption of the capital deficiency or the right of offset. For the right of offset, the journal entry here would be a debit to the loan account to decrease it and a credit to the capital account. Okay, that is 1,000 pesos for the debit and credit. Okay, so this is the journal entry for the right of offset. Now let's proceed to case number 3. Okay, now for case number 3, we have here assume that other assets were sold for 49,500. Okay, assume that other assets were sold for 49,500. So class, this is the case where there is a loss on realization again, but it results to a capital deficiency, and the partner who has capital deficiency is a solvent partner. Okay, so we have here, I'm going to copy the previous one. Okay, so the balances are still the same. Now let's proceed to the realization. Now accordingly, the other assets were sold for 49,500. So we received cash of 49,500 with other assets that is being sold. So that is minus 80,000 pesos. So how much is the loss? We have 49,500 and 80. The loss is 30,500. Now the 30,500 will be absorbed by our partners. So negative 30,500 multiplied by 40% for partner D. For partner E, that is still 40%, but for partner F, that is negative 30,500 multiplied by 20%. So his share is 6,100. Okay, so make sure for this checking to be balanced. Okay, again, the checking is not required. That is just for us to make sure that everything is balanced. So we have cash and proceeds. Okay, for the other assets, we have 0 now. Liabilities, we still have 28 and loan of 2,000. Okay, so as you can see, the loss on realization resulted to a capital deficiency of partner D. Okay, but before that, let us first pay our liabilities. Liabilities of 28,000 pesos minus 28,000 pesos. Now let us compute for the balances again. For the cash, we have 49,500 left. No more liability, while the partner's loan and capital accounts are still the same. Now, next class is to exercise the right of offset. Now, since D has a capital deficiency, then D can exercise the right of offset against his loan account. So, minus 2,000 for the loan, and then add 2,000 for his capital deficiency. Now, class, as you can see, for our balances, so we have no more loan. D has no more loan, but still, he is still deficit. Okay, well, the other partners had or has a positive balance. Now, what we're going to do is, according to the rule, if a partner results to be deficit, then first he must exercise the right of offset. Now, if he has no loan, then if he is insolvent, then he can make additional investment. Okay, so what we're going to do here is that for D to make additional investment. So D will add 1,200 to his capital. So that would also be an additional cash. Okay, so take note class of the journal entry for the additional investment. Okay, for the additional investment, the journal entry would be debit to cash and credit to the capital. Okay, that is for an amount of 1,200. So that's why we added the cash and we also added the capital account. Now after this one, we will compute for the balances. Okay, for the cash, this is now 42,700, and for the rest, we have no capital anymore for D. Well, for E, we are still to pay 8,800, and for F, we are still to pay 33,900. Okay, so this is additional investment. Well, this is payment to partners. Okay, so as you can see, our payment to partners is 8,800 and 33,900. So we're going to add this one, 88 plus 33,900, that is 42,700, and that is the amount of our cash. Okay, so this will be our final payment to the partners. Okay, so that would be for case number 3. Now next we have case number 4. For case 4, so accordingly, in case 4, assume in the preceding case partner D is personally insolvent and the one to due from him is uncollectible. Okay, so we are still to use the case 3, the information in case 3, in which we will assume the other assets were sold for 49,500. But what is the difference for case number 4 is that D is already insolvent. Okay, D is already insolvent. So insolvent or personally insolvent means that D cannot anymore make additional investment. Okay, because in his personal assets and liabilities, he is already insolvent, so he cannot already make additional investments. So class, this is a case where the loss on realization results to a capital deficiency to an insolvent partner. Okay, so class, the balances are the same, the realization is the same, the payment of liabilities is the same, the right of offset is the same. Now, what is the difference here? It's just that for our balances, for the balance of D, he cannot anymore make additional investment because he is already insolvent, unlike in case number 3 where he made additional investment, but in this case he cannot anymore make the additional investment. So what we're going to do is for the other partners to absorb this loss. Okay, absorption of deficiency by other partners. Okay, how will they absorb such deficiency? So for D, he will be added 1,200. Well, for E, he will share for the 1,200 based on his P&L ratio. Now, since E has a 40% share and F has a 20% share, so that would be multiplied by 4 over 6. Where did we get the 6? That is 40 plus 20, that is 60. Okay, so he will share 800. While for F, 1,200 times 2 over 6, and he will share 400. So 800 plus 400, that is 1,200. So that is what we call absorption of deficiency by the other partners. Now, if we'll compute for the balance, we have 41,500, and then okay, we have here the balances of the other partners. So 8,000 plus 33,500, that is 41,500. So we can now be able to pay the remaining partners. Okay, lastly is the payment to partners. So we will deduct 41,500, and then we will deduct 8,000 and 33,500. Okay, so this is for the loss and realization resulting capital deficiency to an insolvent partner. Okay, so class, for the journal entry of the absorption of deficiency, I have here absorption of capital deficiency by the other partners, that would be a debit to the partner's capital account who absorbed the deficiency, E capital and F capital, and credit to the partner's capital account who was deficit. Okay, so by this time, the capital of D will be added by 1, 2, while the capital of E and F will be deducted by 800 and 400 respectively. Okay, so that is for the lump sum liquidation. Okay, so hopefully that you understood the process. It is actually simple. So what is the challenge here is just to is just to be familiarized with the procedures. What are we going to do first? First, we have to sell the assets, then pay the outside creditors. Okay, exercise the right of offset if ever there is deficiency. If there is not, then make additional investment. Now, if the partner is insolvent, then let the other solvent partners absorb the deficiency. Okay, so that would be all for this video, class. If ever you have questions, then feel free to ask me during our video conference. Okay, that would be all for today. Thank you and goodbye.